Warren Buffett is considered the greatest investor of all time. In 1965, he took a few million bucks and over the next 6 decades turned it into over $1 trillion. His return for that amount of time is around 5.5 million%. Meanwhile, the S&P 500 only made 39,000%. And Berkshire Hathaway stock went from about 19 bucks per share to over $800,000 per share, which is absolutely insane. And just a few days ago, Buffett announced his retirement, stepping down as the CEO of Berkshire Hathaway and passing the torch to Greg Abel. So today I thought it'd be cool to share 60 lessons in 60 years from the greatest investor to ever do it, Warren Buffett. And because your time is valuable, these will be at more of a rapid fire pace, so this video is not 3 hours long, and I'll leave timestamps so you can jump around if you like. Let's go. 1965, buy businesses, not stocks. Treat stock purchases as part ownership in real companies. If you're buying the stock just because it has a nice looking chart, you may not last long as an investor. 1966, focus on intrinsic value, not market price fluctuations. Stock prices can be way more volatile than the actual companies underlying them, and so don't get caught up in the day-to-day movement. Focus on the actual business. 1967, reinvest profits for compounding and avoid unnecessary dividends. Berkshire Hathaway has famously only paid a dividend a single time in history, and Buffett often jokes about it, saying he must have been in the bathroom when this got approved. 1968, seek companies with durable competitive advantages or economic moats. Apple is a great example of a company that has an economic moat because they have what's called their Apple ecosystem. Meaning if you buy something like an iPhone, you might want to get a MacBook Pro and then maybe an Apple Watch and some AirPods, and all of them work together. So you kind of get stuck in the Apple ecosystem, and it's a lot harder to switch to other companies. 1969, be patient. Sometimes the best action is to do nothing. In fact, most of the investment gains that we see comes from just sitting on our hands and waiting. And that's one of the reasons why day traders end up losing a lot of money. They confuse activity for achievement. 1970, management integrity and talent are as important as business economics. One of the key factors in picking a company that's going to compound for a really long time is understanding the management team in terms of how skilled they are for creating value for their shareholders. The CEO specifically is probably the most influential individual for a single company, and these people are just as important as the numbers that you're looking at. 1971, avoid businesses you don't understand and stay within your circle of competence. Munger often used this approach with his inversion thinking. So instead of looking for good companies to buy, he would cross out all the companies that he didn't understand, and he would be left with a really good list to start with. 1972, favor simple, understandable businesses with predictable earnings. Simple businesses are easier to project earnings and therefore easier to understand the overall economics of the business. For example, Warren Buffett really loves Coke because he assumed that most people would be drinking Coke, 30 years from now, and they could count on that cash flow to continue to come in. 1973, market volatility often creates opportunity for disciplined investors. Buffett is famous for sitting on cash, waiting to deploy it at the right moments, and 1973 certainly made a strong case for this option. If you're disciplined enough to miss out while everyone else chases market euphoria, it can be rewarding. 1974, be greedy when others are fearful and invest during market downturns. One of Buffett's more famous quotes is to be fearful when others are greedy and to be greedy when others are fearful, and market downturns are the perfect opportunity to buy if you have the guts for it. 1975, ignore short-term market forecasts because they are unreliable. Nobody knows the future. Even the Oracle of Omaha himself admits that he doesn't know what's going to happen today, tomorrow, next month, or even next year. So if he's saying to ignore all market forecasts, I'll take his word for it. 1976, focus on long-term results, not quarterly earnings. So similar to the last point is focusing on long-term instead of the short-term forecast or even quarterly results that create volatility in stocks. And this makes sense too if you're a long-term investor. What is a 3-month report when you have potentially 30 plus years to wait? 1977, inflation is an investor's enemy. You want to seek businesses that can always raise prices. Now this might seem very obvious, right? Businesses that can raise prices year after year have a very obvious competitive advantage, and these are worth looking into a little bit more before you're buying them. Again, Apple is a great example of this. Every year, they continue to raise the prices of their iPhones, and people still line up at the stores waiting to buy the next one. That's one of the reasons why they've crushed for so long, and it's one of the reasons why Warren Buffett bought them back in, I believe, 2016. 1978, the best investment is in yourself. Keep learning. Buffett talks about this a lot in his shareholder meetings. He talks about if you're the best doctor in town or the best lawyer or the best dentist, you could pretty much charge whatever you want, and inflation is going to eat away at your earning power. And to be honest, if you get really good at a single skill, that's going to be a better investment, a better return on your money and your time than almost anything that you can buy in the stock market. 1979, avoid leverage because debt magnifies mistakes. Leverage is amazing on the way up and it's completely devastating on the way down. And Berkshire has used minimal debt and still managed to build up over $1 trillion in assets, so they've pretty much proved that it's not necessary. 1980, good businesses generate high returns on capital without excessive debt. This theme is littered throughout the 1980 shareholder letter. Good companies don't really need to use a ton of debt because they have really great margins and returns on capital by definition. 1981, diversification is protection against ignorance. Concentrate if you know what you're doing. Now, diversification is great for most people who are just working 9-to-5 jobs like us, and we don't really stock pick for a living. But if you do build that skill set, it can pay to concentrate on opportunistic positions and really load up if you have the conviction for it. 1982, buy wonderful businesses at fair prices, not fair businesses at wonderful prices. Now, this is something that I learned from Charlie Munger after starting with Ben Graham. Ben initially taught him what he calls the cigar butt approach, which is to buy companies below their intrinsic value if they have, 1 or 2 good puffs left in them. But Charlie Munger showed him that if you buy really great companies, even if you're paying at fair price for them, that's how you get long-term compounders that really outperform the market. 1983, invest with a margin of safety and don't overpay. So at the same time as the previous lesson, it's also crucial to buy below intrinsic value if the opportunity arises, and you should always do more research and thinking before you overpay, even if the business looks really good. 1984, time is the friend of a wonderful business, but it's the enemy of a mediocre one. Charlie Munger famously said the first rule of compounding is to never interrupt it unnecessarily, and the only way to get long-term compounders and make tons of money is to give them time. 1985, look for honest and able management and avoid thumb sucking or delaying tough decisions. Warren learned from Charlie Munger to never avoid fixing mistakes quickly, especially if that requires difficult decisions, because you're really just kicking the can down the road. In one of their letters, he says the cardinal sin is delaying the correction of mistakes, or what Charlie Munger called thumb sucking. Problems, he would tell me, cannot be washed away. They require action, however uncomfortable they may be. 1986, avoid institutional imperative. Don't follow the crowd. Don't just do what everybody else is doing or what's always been done. And over the years, Buffett has often seen this with even the most experienced managers falling into this trap and making bad decisions with things like compensation, acquisitions, or expanding businesses when really they should not be. So instead, he prefers to think independently and avoid the herd mentality, which I think is one of the reasons why he has such great outperformance for 60 years. 1987, be prepared for market crashes, stay rational and opportunistic. Now, it's very easy to say that you're gonna buy when the market drops 20%, but it's way harder to do that when you let emotions come in from headlines that tell you that you should be panicking right now. But oftentimes that can be the signal you're looking for to jump on an opportunity if you have the money available and if you have the guts for it. 1988, compounding is powerful. Let your investments grow. Now, this one is simple, but it's often the hardest discipline because investments aren't linear. And it's in those deep valleys when the market dips and we see our portfolios go down a bunch. That's what makes it hard to leave our investments alone because we think we should be doing something in order to fix it. 1989, don't confuse activity with achievement. Trade less and think more. Similar to the advice from 1969, most traders lose money thinking that if they just make one more trade for the day, that's how they can be profitable. Meanwhile, your neighbor who just dollar cost averages into an index fund is a millionaire before you because they keep things simple. 1990, mistakes are inevitable. Admit and learn from them. Don't pretend you're perfect and acknowledge the mistakes you've made and move on from them as quickly as possible. You'll notice this is a theme throughout because it's such an important topic. 1991, reputation takes years to build and seconds to ruin. Protect it at all costs. Buffett warned others how important reputation is after dealing with the Salomon Brothers scandal in 1991. It's not a huge deal to lose money, but if you screw up a reputation, that can be near impossible to fix. And check out this clip from him.
Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless. I welcome your questions.
1992, don't rely on past performance, assess future prospects. Now, markets are always forward-looking and past performance is not indicative of future returns. So just because we saw something happen in the past doesn't mean it's going to continue to happen in the future, and often it's usually the opposite of that. 1993, stay humble. Success can breed complacency. Now, 1993 was one of the many years that Warren made mistakes that he later openly admits to. In this instance, he bought a company called Dexter Shoe that ended up failing by 2001, and he learned a great deal about always staying humble and carefully assessing a company's long-term competitive advantage before buying it, especially with Berkshire shares. 1994, investing is simple, but not easy. Discipline is key. Buffett argues that the best strategy is to focus on the fundamentals, buying businesses with good economics, run by honest and able people at sensible prices. 1995, partners matter. Align with shareholders and managers who think like owners. Buffett talks about this a lot over the years, but the reason that he loves companies that are founder-led is mainly because they have skin in the game, and they're much more likely to make the business successful over the long run since it's directly tied to their wealth and livelihood. 1996, avoid businesses with high capital needs and low returns. Both Buffett and Munger often highlight this fact and use companies like airlines as an example. They are very capital intensive, meaning they need a lot of money to keep running and the margins are super thin. These are not the characteristics of a long-term compounder. The worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. Here, a durable competitive advantage has proven elusive ever since the days of the Wright brothers. 1997, be skeptical of innovative financial products. Understand what you own. Now, this goes back to his timeless principle of understanding what you're invested in and to keep things simple and be wary of things that are overly complex. One example is derivatives like the futures and options markets. Generally speaking, Buffett and Munger were not fans of these financial products. 1998, size is the enemy of performance, at least in Berkshire Hathaway's case, because larger companies grow slower. Now, they ran into this with Berkshire Hathaway, and it was far easier to grow Berkshire at a rapid pace in the 60s and 70s than it is today when they have over $1 trillion in assets to manage. And that's simply because there aren't enough great companies to buy with that much money, and Buffett even admits that this is one of the hardest problems that he has yet to figure out. 1999, beware of market manias and stick to fundamentals. Now, this was right in the middle of the dot-com bubble when every company with a website was blowing up on the stock market. The Oracle of Omaha may not be able to see the future, but he certainly provided timely advice at one of the craziest bubbles that we've seen in decades leading up to this. 2000, technology is not always a moat. Invest in what you understand. Now, Buffett cautioned us that not all technology companies have durable competitive advantages, and investors should avoid businesses that they don't fully understand and always stick to their circle of competence. And he calls out tech specifically because this is right in the middle of the dot-com bubble. 2001, crisis reveals true character. Stay calm and rational. Buffett emphasizes that turbulent times, such as the aftermath of 9/11, test both leaders and investors, so make sure that you're composed and always making rational decisions to ensure long-term success. Panicking at the bottom is never a wise decision. 2002, corporate governance matters. Watch for misaligned incentives. So he warned us that poor governance, meaning how you run a company, and incentive structures can lead to terrible outcomes for management, employees, investors, pretty much everybody involved. And this is what Charlie Munger had to say about incentives as well. I think I've been in the top 5% of my age cohort all my life in understanding the power of incentives, and all my life I've underestimated it. 2003, don't chase returns, focus on value and risk. Now, Buffett advises against pursuing hot trends or high returns at the expense of sound analysis, and he reminds investors that the best results come from balancing potential reward with prudent risk investment. 2004, the best investments require little oversight. Find great managers. So he highlights that Berkshire's most successful companies are led by talented, trustworthy managers who operate independently, which often frees up headquarters from micromanagement. And I think that's one of Berkshire's long-term recipes for success. And they even joke about this at some of these shareholder meetings where they say they want to find companies that are so good even an idiot can run them. 2005, avoid complex derivatives and excessive financial engineering. Again, he warns us that complicated financial products can obscure the actual risk and lead to devastating losses. So what you should do instead is advocate for simplicity and transparency in your investments. 2006, insurance float is a powerful source of investment capital. If you don't know, in insurance, float is essentially free money to invest in while you wait to pay insurance claims. And he explained that the insurance operations provide Berkshire with low-cost capital, which is the float, and that helps them invest elsewhere, which basically fuels the company's growth and compounds their returns over a long period of time. 2007, prepare for the unexpected, maintain liquidity and flexibility. Yet again, the Oracle of Omaha's timing is near perfect. He's basically saying to hold a good amount of cash so that you can weather storms or jump on opportunities if they arise, which we know from hindsight was about to happen the following year. 2008, in crises, act decisively because opportunity is greatest in turmoil. His quote comes to mind about being greedy when others are fearful or to buy when there's blood in the streets. And during the 2008 financial crisis, Warren Buffett showed us that his well-reasoned investment philosophy can yield incredible long-term results. 2009, government actions affect markets. Understand macro risks, but don't bet on them. Nobody knows the future, and that includes Charlie and Warren, and he acknowledges that policy decisions can impact businesses, but he also cautions against making investment decisions solely on the predictions about government or macroeconomic trends. 2010, shareholder communication should be candid and transparent. Buffett has led the charge in valuing honest and straightforward reporting to shareholders, and he often openly admits the mistakes that he made and provides clear explanations of business performance. To this day, it's almost taboo for public companies to admit that they made mistakes, even if we know that they did and it's very obvious. And I think that's one of the reasons why people admire Berkshire so much. 2011, succession planning is essential. Build lasting institutions. This year, Buffett reminds us of the importance of preparing for leadership transitions, especially when it comes to Berkshire's culture and success to endure beyond any single individual. And as we heard just a few days ago, he's passing the torch to Greg Abel, who is more than capable of handling this weight. 2012, taxes are a cost of success. Don't let tax avoidance drive your decisions. Buffett has said plenty of times that paying taxes is a natural outcome of business, and it should not be the primary factor when you're making any type of investment or operational choices. In fact, Berkshire has been set up for years to pay more taxes than they could have if they set it up a different way, but that obviously hasn't stopped them from creating a trillion-dollar empire that they have today. 2013, don't overcomplicate investing. Stick to your principles. Again, he reminds us that simple, time-tested strategies that focus on value and discipline outperform complex schemes or constant messing with your portfolio. 2014, the best holding period is forever. Buy businesses to own indefinitely. Buffett has almost always advocated to buy companies with the intention of holding them forever. This is the best way to benefit from compound interest and to avoid any unnecessary costs with trading and taxes. 2014 was also the year where he fully explained his succession plan in a lot more depth than he had previously, which has finally come to fruition 11 years later. 2015, focus on per share intrinsic value, not just reported earnings. He encourages shareholders to look beyond the headline reported profits and instead assess how each share's underlying value is growing over time. Now, this was a big shift from looking at just book value to understanding the business as a whole through quantitative and qualitative metrics. 2016, global diversification can reduce risk and enhance returns. Buffett acknowledged that investing outside of US borders can provide new opportunities and also help mitigate some risk to any single economy. They've done this with a bunch of countries over time, but the one that I most recently remember is with Japan. This doesn't mean that Berkshire was avoiding US companies after 2016, but it's more of a reminder to not get tunnel vision in the US just because it's had such strong performance in the past. 2017, be wary of excessive optimism because markets can disappoint. At this point, we're 7 years into a really long bull market, and he's cautioning against assuming that strong markets will continue indefinitely and reminds investors to remain realistic and prepared for setbacks. Again, another strong argument to hold some cash on the sidelines like in US treasuries when markets start to get a little too exuberant. 2018, technology changes fast, but human nature doesn't, so watch for bubbles. Here, Buffett notes that while industries evolve very quickly, investor psychology typically remains the same, and it's crucial to avoid any type of speculation or asset bubbles. Lucky for all of us, 2018 didn't turn out as bad as investors were anticipating. 2019, mistakes are part of the game, correct them quickly. Buffett openly discusses his errors as he's done for decades now, and he always emphasizes that acknowledging them and then quickly addressing them is vital for long-term success. It does you no good to take your time when you know you've screwed up. 2020, resilience matters, so build businesses that can withstand shocks. Buffett was of course referring to the market crash in March and always giving us a reason to anticipate black swan events as best that you can. The pandemic obviously revealed to us that we need to look for really good businesses with strong balance sheets if we want to avoid any type of unforeseen disruptions. 2021, humility and adaptability are vital in uncertain times. So he stresses that nobody can predict the future with certainty, so investors and leaders must always remain humble and ready to adapt as conditions change. And this came during a year of yet another bubble with things like e-commerce and meme stocks that were blowing up during the shutdowns. 2022, don't be afraid to hold cash when opportunities are scarce. Now, history doesn't repeat, but it often rhymes, so right after a bunch of bubbles, we usually have some type of crash, and that's exactly what happened in 2022. Now, for the third time in this list, Buffett understands the macro environment at play, and he explains that patience and discipline sometimes mean waiting on the sidelines with cash until attractive investments come up. And this year, the market was down over 18%, while Berkshire was up 4%, so they beat the market by 22%. 2023, transparency builds trust, admit to errors, and share lessons. I don't think Buffett can stress this point enough. If you candidly discuss your mistakes, it gives you credibility with your shareholders and it helps everybody else learn from the experience as well. There's no point in trying to pretend that you're perfect because really that only damages your reputation. And I love that he shares his mistakes because I think it's better to learn from the mistakes of others than just try to make all of the same mistakes yourself. 2024, praise by name, criticize by category. Now this is advice that he learned from one of his friends and mentors, Tom Murphy, and he's used it for over 60 years now. He often recommends leaders to publicly recognize individuals when they do really well, and only address shortcomings in general terms. So there you have it. That was a really long list. I'll leave a summary on the screen here so you can pause and take a screenshot of every year from 1965 all the way to 2024. And I'll leave links to every one of Berkshire Hathaway's annual shareholder letters below if you want to read through the wisdom that created the greatest investor to ever live. Otherwise, check out this video next to change your finances in 6 months, and I will see you there. Peace.